the macroeconomic report is coming out today, and George Cherian, our banking editor, is here with us. What do you make of it, George?
Right. So if you just go by the broad tone of the document, it does seem to confirm the market view that you will see a quarter percentage point in the repo rate tomorrow, possibly nothing on the cash reserve ratio front. Now, what the RBI has said is it's actually made a case for the extremely challenging position that it is in right now. It's talked about the fact that growth has taken a hit. It has acknowledged that, and it has been acknowledging that fact for some time now. But it has also spoken about the fact that inflation continues to remain a big concern, that inflationary pressures continue to persist within the system, and it has actually spelt out a number of those inflationary challenges. One of them, of course, being the obvious one of fuel prices, the fact that fuel prices remain at elevated levels and that they are expected to go up should geopolitical risks once again begin to accentuate further from here. The RBI has also spoken about wage price pressures remaining within the economy, the fact that high protein food items remain very inflationary in nature. A number of reasons it's actually listed out to make a case for inflation continuing to remain at elevated levels in the current financial year. It's also spoken about the fact that growth will be quite challenging in the period going ahead. The fact that you have advanced economies going through a number of challenges of their own. The fact that what's happened in advanced economies has had a rub-off effect on emerging and developing economies, which in turn has slowed growth in these regions. And also the fact that within India itself, you've seen a huge breakdown in private investment, which has in turn had an effect on economic growth per se. So it's effectively made out a case for slowing growth, but at the same time inflationary challenges continuing to persist, which in some sense makes the task of monetary policy management that much more difficult. Now it has, and this is something that it raised very strongly in the January policy, the fact that it needs to see more being done on the part of the central government by way of addressing issues like suppressed inflation. And it has spoken about the fact that monetary policy by itself trying to tackle inflation or trying to support growth is not going to work in the absence of fiscal action. Strong fiscal action coming from the central government, and it has spoken about the need to address what it's referring to as suppressed inflation, the fact that fertilizer prices, oil prices, diesel especially, continue to be at subsidized rates, the fact that you need to let those prices go, you need to right price the cost of these goods, these petroleum goods and fertilizer goods to market prices, and allow demand then to determine those prices really to determine what the true level of demand is, which in turn will have a possibly cooling effect on inflation going forward. So it's actually made a very strong case for itself in terms of the fact that its hands are tied in many ways. The fact that it can't let interest rates go so easily simply because the challenges of inflation continue to persist within the system. So what you will possibly see is a baby step approach to cutting rates by the Reserve Bank of India going forward. A quarter percentage point possibly in the repo rate cut is what you'll maybe see tomorrow, going with the tone of the document. On the cash reserve ratio, very unlikely that they will cut rates as some bankers have been expecting, because it's made the case it's actually explained how the CRR cuts, the 125 basis points in CRR that it has cut, and the OMOs of something like over 2 lakh crore rupees that it has returned to the system have had actually a very cooling effect on the liquidity situation here in the banking system. So on the CRR front, quite unlikely that he's going to do anything. But on the repo rate front, you could possibly expect a quarter percentage point rate cut tomorrow.
Okay, George, and you said that inflation still remains the key challenges as per the macroeconomic report as well. So how is the balance between growth as well as inflation going to go ahead with, and how is RBI going to really balance between the two?
So that's exactly the point I made, Nisha, the point that the RBI has acknowledged the fact that it has acknowledged the fact that growth has taken a hit in its fight against inflation. It has also talked about the fact that inflation has in some part come off due to growth having declined. What it has said is that while it realizes that it needs to focus on supporting growth, you need to remember that inflationary challenges or inflationary pressures continue to persist very strongly within the economy. And some of those points that I listed out for you, these are pressures that are beyond the control of the RBI or even the center. These are essentially supply side pressures. So you've got the price of oil, crude oil, which is holding at about $120 a barrel now. Should the geopolitical situation worsen, you will see oil prices climb further from here. Wage price pressures continue. You constantly see, the fact that wages are going up year on year, and India's seen the highest level of wage price inflation in the Asia region for at least 7 to 8 years now. So an expectation that wage price pressures will hold up, and that in turn tends to feed in on inflation. The fact that high protein food items, things like milk, eggs, meat products, these are products that for which there continues to be a fairly high level of demand, and on account of that, the inflation on these food products remains high. So the RBI has listed out the number of challenges it faces on the inflation side. It has spoken about this whole dynamic between growth and inflation needing to be managed. It has also acknowledged the fact that growth needs to be focused on a little more strongly, so which is why I made the point about the RBI likely moving ahead in the direction of policy rate cuts. But the approach will in all probability be a baby step approach. You will only possibly see a 0.25 percentage point cut in the repo rate. Tomorrow you won't see much more than that. There are bankers who are expecting as much as a 50 basis point cut in the repo tomorrow. That's quite unlikely to happen, for the simple reason that it needs to balance inflation with growth. It is not going to let the repo rate or the policy rate go so easily, because it needs to be mindful of the fact that inflationary pressures continue to persist.
Right, George, you said that the RBI is expected to take baby steps as far as cutting rates is concerned. That we'll see tomorrow. But what about the manufacturing sector? What does the report talk about the industry concerns there?
Well, on the industry front, I think it's been a well-documented fact that you've seen private investment take a very, very severe hit. Most business houses you speak to will tell you that private investment is pretty much on the back burner. But it is not simply for the reason that, interest rates have been holding at, multi-year highs. It's got to do with much more than that. It's not simply about the RBI having raised rates that, industry is holding back on interest rate, that the RBI that industry is holding back on private investment. It's got to do with a number of other issues. It's got to do with policy at the central level. It's got to do with, a host of other issues like environmental issues, land acquisition issues. It's not simply about interest rates. And I think most industrialists you speak to will tell you that interest rates is just one of many factors that weigh on their minds when they talk about increasing investment or expanding capacities. It's more about issues at the center. It's more about a lack of clarity on policy issues at the center. So yes, interest rates is one point, but it's not so much about that alone. It's got to do more with policy at the center. So manufacturing is under pressure, and I think that's got to do, that's something that's been borne out by the IIP numbers that we've seen month on month. We saw the IIP number for February, which came out just last week at 4.1% against a number of 6.4, 6.8 that some people were expecting. You also saw the January number being revised downwards. The January number was revised down to 1.14% against an earlier number of 6.8%. So everyone acknowledges, and I think the RBI also acknowledges the fact that manufacturing has been a huge casualty of what you've seen play out over the last 18 to 24 months. It's not, however, purely about interest rates having held high. It is for the, like I just mentioned to you, a host of other reasons have also got to had a role to play in that.
Right, George, you said that inflation and interest rates are not the only reasons. But just one question on 25 basis points cut. If that comes in tomorrow, how much of a cheer will that be for the investment community? Will it really ease anything, or will it be a long-drawn approach where there could be more cuts in the future and then some positivity could come in?
Right. You see, Nisha, the markets have already factored in a 0.25 percentage point cut tomorrow. Now, the bond markets have already priced that in to the price of the 10-year bond. The equity markets in some way have also factored in a rate cut, a 0.25 percentage point rate cut. what you will, I think the big concern for the markets will be if you don't see that cut. I don't think anyone should, for even a moment, expect a half percentage point cut in repo rate. But having said that, the RBI has surprised us in the past. You may even see that. Should you see a half percentage point cut in the repo tomorrow, it will be a huge, huge positive for the markets. You will see bond prices come off very strongly. You will see, bond prices go up strongly. You'll see yields come off very strongly. You will see the equity markets witness a fairly strong rally. What the markets have factored in right now is a quarter percentage point cut. The disappointment really will be if you don't see that cut come in. And that difficult to say at this point. All of us are just trying to second guess what the RBI will announce tomorrow. But I think for now it's safe to assume, going by the tone of the document, that you will see a quarter percentage point cut tomorrow.